Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's see if we have any other questions. Question from William: why is there a wisdom tree yuan ETF? I think that you actually talked about that, or maybe I'm mistaken. Is that what you were saying about how so the ETF is out there, but it's only going to really appreciate if we can see a one-off increase? Is that correct, Jack, or am I mistaken?
Correct. That's correct. Because it's pegged, it doesn't move up, especially if you're a dollar investor. If you're an investor, a euro investor, that's your base currency, and you bought this, and the relative value would go up as the dollar went up against the euro because the Chinese currency is pegged to it. But from a U.S. investor standpoint, if the peg is maintained, you get no appreciation, no matter what the dollar does. So it's a nonsensical investment unless you really think that they're going to increase the value of the currency. And now may be a time to make a small bet on that. 5% one-off appreciation in the currency would allow this particular fund to appreciate.
Oh, and we just don't know. There'll be some fractures in certain currencies, don't you think? If they did that.
I don't know. I think it's. I don't think it's necessarily is a bad thing for anybody really. We keep pounding our head against the wall and trying to find where the badness is here, a one-off appreciation, and we're having trouble finding it. I don't think so. Okay.
Chalmers has a question. Do you see the dollar being replaced? And I know you and I spent a lot of time last year together at either doing these webinars or live presentations, and I think a lot of folks have asked this question. Do you see the dollar being replaced as the reserve currency in the next couple of years? What do you see there, Jack?
I don't. I think the global monetary system is incredibly flawed with the dollar at the core, or any currency at the core. That is a domestic. You have domestic pressures on a currency, and when you have domestic pressures on a currency, that has to be a global currency too, as the dollar is. It's just a very flawed process, but it's one we're stuck with for a while. You just don't change the global monetary system, flip a switch. So I don't see the IMF having the ability to create, to pump up these SDRs, and it's a theory in which Soros is pushing very hard to turn the SDR into a global currency. Ultimately, we may get there, as I said, because the system is quite flawed, have a domestic currency pressures and being a global currency at the same time. The point, it's not necessarily good for the U.S. either to have its currency being a global currency. In one sense, it gives them a lot of power, a lot more economic power to a degree, and political power to a degree, but same token, it locks the U.S. into these massive current account deficit potential problems because the U.S. dollar has to fund the global growth as the world currency. So the point of having a domestically neutral global currency product is very enticing theoretically. I can't say that word too well. Theoretically, thank you. But getting there tactically and from a system standpoint I think it's going to take many, many years and not just a few years away. 10, 15, who knows?
Right. Well, Jack, here's another question. Fred says, you mentioned that the U.S. could become a net exporter after global trade rebalancing takes place. Do you mind elaborating on how that could actually occur? And given the fiscal position, obviously it's two different things. one is the government spending and one is the private sector, correct, Jack?
Yeah, they're two different things. They are. You have the fiscal side, and then you have the trade balance side. Well, if you just look at the current account deficit, and you can get a chart of that at most places for free, you see since 2007, late 2006, it started, which was, I think, is part of the credit crunch problem. You see the massive improvement in the U.S. current account area, which means we've actually are importing less because the U.S. consumer is savings more as part of that rebalancing. We've seen an improvement in the process in which the U.S. dollar has increased in value, and we've seen a big improvement in the U.S. current account deficit. If the sentiment change from a secular standpoint it becomes ingrained in the U.S. consumer, and he starts saving more and stops spending less in the future, and this massive dislocation has really scared him, it means the U.S. creates its own domestic pool of savings. And if we see China develop their domestic market and trade go the other way, start to flow naturally. Already, if you look at the U.S. export component, the growth in emerging markets is very good for the types of things that the U.S. makes. And subtly, the U.S. export growth has been very, very good underneath the surface that people don't talk about much, and it's part and parcel to the improvement in the emerging markets. We ship a lot of stuff that they want there, so you have that dynamic of that world growing. You have more balanced trade of Asia actually start to wanting Western goods if they unleash their consumer, and you have a secular change in U.S. spending patterns. You could see the current account go positive pretty quickly. It's already gone positive. It's already improved tremendously. And if you would have asked the economists, how are we going to improve the U.S. current account, they said this 3 years ago, the U.S. dollar has to depreciate another 50-60% in order to make any improvement in the U.S. current account. Well, you notice that the improvement in the current account has coincided with the dollar increasing in value. Which goes to show us, let's not listen to economists when they talk about global macro flow and the dollar. I saw Feldstein from Harvard was mouthing off again today, absolutely clueless in terms of global macro and trade. But the numbers are bearing it out. So don't listen to what people say. Look underneath the numbers, and you'll see it. You see it happening. Will it stop? Maybe, but it's not a far-fetched to see the U.S. current account go positive, and that was our prediction about a year and a half ago, in fact.
That's a good point. In fact, I haven't finished the book, but Mark Chandler, he wrote a book, Making Sense of the Dollar, and he talks about some of the crazy myths that most of the analysts talk about and how they're just not true. I haven't finished the book, but I don't know if you finished the book, Jack. But it's very interesting that he brings up some points that makes you wonder that everything that we read about the current account, and he actually dispels some of these things and say, don't just look at that. There's much deeper things to look at than just the current account itself. In fact, how flawed it is.
Yeah, he's great. That's Mark Chandler, and if you guys want to find him, he's at Brown Brothers Harriman. Very good, very good. He's always, he kind of thinks outside the box, and
exactly.
He's very good.
Which is nice.
Yeah.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.